morning to all, and welcome to our webinar today. I'm Suresh Iyengar, and I'm a business advisor with the North Central Texas Small Business Development Center. Today is World Mental Health Day, so please take care. SBDC is a leading provider of assistance for small businesses. We are grant funded, which allows us to offer services at no cost to you, the business owner. A quick reminder, we will be recording this webinar and then adding it to our YouTube channel. Today's webinar will be interactive, so please feel free to raise your hand, which is the small button at the bottom, if you have a question or comment. Our presenter today is Bryce Forney. Bryce is a Bay Area sole prop CPA preparing tax returns, mostly for business owners who use cloud books for their business. He is an understandable, likable, mobile accountant working in hotel lobbies, libraries, and liquid spaces. Welcome, Bryce.
Thank you.
Please take it over from here.
Okay, will do. Okay, so hopefully you can see the title slide here. We're going to talk about this always hot topic of what is the right entity choice for my business. And I'm going to lead by specifying that we're talking about when we're talking about tax implications specifically. I'll allude to some of the legal parameters around entity type, but really this is focused on helping you understand what the tax implications are by entity for your business. And we'll go through an actual example so you can see how the taxes are, pros, cons, that sort of thing. So we always reference the importance of using your resources as a small business owner. So there are SBDCs across the country. And of course, I'm partial to the North Central Texas SBDC, but all of the SBDCs are great resources for you as a business owner. So just a quick introduction about me. I am a CPA. I work with cloud books and prepare tax returns. So that's basically what I do. There's not much else to it. So I thought we would begin by defining what entity types are out there and available. And there's kind of a permutation that I'll speak to in a second that I'm glad came up before we came on here. So the default entity type, if you do no filing at all, you are by default a sole proprietor, one owner, where you're operating essentially as a form of your name. So you could be, I'm Forney Accountancy. You could be just your name and profession. Could be, Alan Alda, architect, something like that. That means that you're a sole proprietor and there's no filing, no registration required. If you have more than one owner, then you are by default a partnership. Again, no filing required, although it is now required in California, at least, for even a general partnership to file with the Secretary of State simply to get an account number that can be used for e-filing. So it's a bit of an exercise, but of course e-filing is important. So that's the base default. If you do nothing, you're going to be a sole proprietor if you're a single owner, or a general partnership if there is more than one owner. And then there are essentially two different forms of being incorporated. So if you file with your state Secretary of State, it would just be Secretary of State. Of course, it's a state agency. So you are registering to be a corporation, and it's a pretty simple filing in terms of the exercise. You're just saying who the owners are. You will also likely get an employer identification number from the IRS so that the entity has something to use on its tax return, a number, so that the IRS recognizes the entity. And when you get an employer identification number, an EIN, it's very easy to do online. And when you get that, you tell the IRS, I'm a corporation or I'm a sole proprietor. I just don't, I mean, you could get an employer identification number for as a sole proprietor or as a general partnership. That's an option. I prefer to have an employer identification number so that since I'm a tax preparer, my tax ID shows up on the tax returns that I prepare. So I prefer that not to be my social security number for obvious reasons. So I've gotten an employer identification number, 2618603. Wait, it was 26. Oh no, now I forgot it. I have it just in my head, and then I go and open my mouth, and now I can't remember. 1863-204. That's it. It's 26-1863-204. Got to be good with numbers. And then a separate type of corporation is a limited liability company. So with the Secretary of State, you are still filing to be a corporation, but you are saying specifically that you want to be a limited liability company. It's just another iteration of a corporation. So corporations and LLCs vis-a-vis the Secretary of State are effectively the same. They, at least in California, they just have a different set of numbers. A corporation would have a 7-digit number with the Secretary of State, and a limited liability company would have a 12-digit number. But it's essentially, they're both forms of a corporation. So those are really the three entity types that any business can be. And if you are a corporation or an LLC, that can work for one owner or more than one owner. So where a sole proprietor turns into general partnership with more than one owner, a corporation can have one or more owner, an LLC can have one or more owner. And then finally, a note on the LLC, once you have filed with the Secretary of State and they stamp your articles and say, okay, you're an LLC, if you would like to file a tax return as an S corporation, you can do that as an LLC. And the process there for any, if you become a corporation from the Secretary of State, you would still need to file with the IRS for them to accept your election to be taxed as an S corporation. And we're going to go through the details of the taxation. I just wanted to make all of the entity types as they're reflected in the tax returns. So if you're a corporation, you can file with the IRS so that you get taxed as an S corporation. If you're an LLC, you can file with the IRS to be taxed as an S corporation. And that form is 2553. Again, a simple one-page form with the IRS to allow you to be taxed as an S corp. So now let's switch gears. We've got the same entity rubric here, but we're going to apply the taxes that are encumbered upon each of these entities. So if you are a sole proprietor, sole owner, or a general partnership, same, not registered with anybody, but you have more than one owner, all of your income, well, your revenue less all of your expenses, your net income, is subject to two taxes. It's subject to self-employment tax and it's subject to income tax. The self-employment tax, if you're unfamiliar with that term, that is another way of saying Social Security and Medicare. Those are the two taxes that make up self-employment tax. So it's 15.3% up to something like $160,000 or something. And then the Social Security, 12.4% drops off, and you're left with a 2.9% Medicare tax. And the Medicare tax goes up no matter how much you earn as a sole proprietor or general partnership. You're going to be subjected to the Medicare tax on your net income. So if you make $1 million, you're going to have that 2.9% times the million for your Medicare tax, and you're going to have 12.4% for FICA for Social Security on about 160,000 of earnings. The number changes each year, and my expectation is that that number is going to get significantly larger as the pool of working individuals is smaller in relation to the number of retired individuals. Some people think that Social Security is like goes into a bank account and then comes out. Leave it to the United States government. What it actually is workers now are having Social Security and Medicare withheld from their wages, and self-employed individuals are paying it through self-employment tax. And then those dollars are paid out to Social Security recipients. So, I mean, there is talk of when Social Security kind of runs out of funds, and that what that really is when the ability of the United States to collect from wage earners and self-employed individuals outstrips what the benefit payout is. That's not our topic today. I just dove into that. I don't know why. So if you're a sole proprietor, general partnership, self-employment tax and income tax, those are the two taxes. If you're a corporation, it depends on whether you're a C Corp, which is the default, or you elect to be an S Corp and the IRS accepts your election. If you file as an S Corp, then, well, in either case, the wages that you pay, if you're a corporation, you're not paying yourself through draws like a sole proprietor or partner would. You have to pay yourself through wages, and then you receive a W-2. Even if you're the owner of the company, you would receive a W-2 for those wages at the end of the year. So your wages are subject to payroll taxes. Those are primarily made up of Social Security and Medicare, but there are some additional payroll taxes. And in California, the most significant one really is state disability insurance, which maxes out at, I don't know, something like $1,300. So not a tremendous amount necessarily, but it's basically the way that you pay self-employment tax. That's most of it. So you're subject to payroll taxes on wages and income tax. And then the corporation, if it's a C Corp, is going to be subject to a corporate federal tax and a state franchise tax. So the franchise tax is kind of another way of saying state tax on corporate income. But it can technically not be percentage. It could be a flat amount or the greater or lesser of a given condition. So that's just known as franchise tax. It's the way states tax corporations. And then if you're an LLC, if you're a sole owned LLC and you have not elected to file as an S Corp, then you're going to file just like a sole proprietor. There's a separate state form, and there is state franchise tax with an LLC, but it's very similar to a sole proprietor. So self-employment tax and income tax are subjected, or the income is subjected to those two taxes. And then the LLC is separately subject to state franchise taxes. And in California, there are two different taxes that apply to an LLC that are different from a corporation. So those are the taxes in written form. And then what I thought might be helpful is to show these taxes broken out. They're itemized, and then as they apply to entity type. So it's really the same chart as we had before, the same matrix. But here, we're showing what entity pays what tax. So notice that whether you're a sole proprietor or an S Corp or a C Corp or an LLC, you're going to pay the self-employment, which is Social Security and Medicare. I've shown it as FICA here. Sorry, that's just me going into payroll terminology, but it's Social Security. And then your income is also subject to income tax, no matter what entity. So keep this in mind. I feel like there's a fair amount of misinformation, well, really propaganda, that is out there about why you should incorporate, why you should become an LLC. And I feel that the reason that propaganda is out there is because it's from the sources of I don't want to mention any specific legal document assistance companies, but attorneys and accountants love to have businesses be incorporated and be LLCs because that creates additional work for attorneys and accountants. I'm not that way, but I'm telling you, I think this is why this propaganda is out there and why I'm so eager to share the reality with numbers about what you're actually going to encounter. So no matter what entity, you're subject to self-employment tax and income tax. If you're an S Corp or a C Corp, then you're going to have those additional payroll taxes. It may be state unemployment insurance. It will be federal unemployment tax and the state disability insurance. I mean, it depends on your state. I'm speaking as a Californian. So there are some additional payroll taxes. They're not significant, but they are additional taxes. So those apply to S Corp and C Corp. And then if you are a C Corp, if you don't elect to be taxed as an S corporation with that Form 2553, then the income of the corporation is going to be subject to federal corporate tax and state franchise tax. Many C corporations will actually, at the end of the year, they'll find out how much income the corporation is going to have, and they'll run one last payroll for the owner so that corporate income is actually zero, and all of the income is effectively pushed into wages. And that avoids the same dollars being taxed twice, because the corporation would pay tax, and then if it pays dividends or pays wages on those dollars in the future, those will be subject to income tax again in the future. And then if you are an LLC, it's pretty much similar to being a sole proprietor. You're going to pay the self-employment tax and the income tax, but then you're subject to state franchise tax. And in California, you're also subject to a flat LLC fee that's based on how much total money your LLC has generated in income. So as you can see, and this is like, I don't really have an ulterior motive here. The impetus of this is to make it clear what taxes apply. But as you can see, the leanest entity type in terms of tax, the one with the fewest X's, is being a sole proprietor or general partnership if you have more than one owner. Then your income is subject to self-employment tax and income tax. And if you're a sole proprietor, you don't have to file a separate tax return for the entity. You just file Schedule C included in your individual tax return. So incorporation, whether it's becoming a S Corp, C Corp, or LLC, is always going to add tax. It may not be that significant, and certainly there is a big difference from state to state about what franchise taxes apply, but necessarily you're going to be filing an additional tax return for the entity, most of which are prepared by professional tax preparers, and you're going to be subject to some additional tax, or at least that's an option. So I thought, well, let's take these taxes and do an actual example so that you can see some dollars involved with a sample business. So we're going to take a California business that grosses just over $250,000 and nets $150,000 in income. After all expenses, we've got $150,000 in income. So a sole proprietor is going to pay the self-employment tax and the income tax, and that's it. So 47.5 is going to be the total tax on that income. If that owner is an S corporation, they're going to pay the same self-employment tax and income tax. They're going to pay it through wage withholding as well as employer payroll taxes, but effectively they're going to pay the same exact amount on the wages paid to the owner. And then there are going to be some additional payroll taxes. These are actual amounts from if you were a California taxpayer. And then the state has a franchise tax that is the greater of 1.5% of net income, or $800. In this case, the $150,000 has all been added to wages. So the S Corp net income is actually zero. So we're just going to pay the $800 minimum state franchise tax. And then if you're a C Corp, you're subject to all the same taxes as the S Corp. And if the corporation has any income left over, one of the things that both S Corps and C Corps can do is they can modify the amount of wages that they pay to the owner. So if the C Corp decides, I'm going to pay less, I've got $150,000 and I'm going to make most of it, say $125,000 wages to the owner. And one of the reasons to make that number as high as possible is that retirement contributions to a 401k or SEP IRA, those are based on wages earned. So, but I want some money to be left over as corporate net income. So if you had $25,000 left over, that's going to be subject to federal corporate tax, which is going to be at least 10%. And then if you're an LLC, you're going to pay the same self-employment tax and income tax, and then you're going to pay the state franchise tax. And then because revenue, this is a California specific example, because revenue is more than $250,000, you're going to pay an additional $900 LLC fee separate from the tax. So that's $1,700 to the California Franchise Tax Board for the privilege of being a business in an LLC in California. So there are two things I want you to notice about this graph. One is that in this example, the most tax efficient entity is the sole proprietor or general partnership. That would be the same thing with just multiple owners. And second, the difference in this example between the tax that a sole proprietor would pay and the S Corp is the highest example, may not be that significant to you. So we're talking here about $2,500, that may be worth it just to know that you're a corporation, have a better feeling about your business because you're incorporated. What's not shown here is if you're going to have your tax return, almost all S Corp, C Corp, and LLC tax returns in the United States are prepared by a professional CPA or enrolled agent or a professional tax preparer. So because of that, because that's the common scenario, you're going to have some cost to the preparation of the S Corp tax return, separate from your individual tax return, or the C Corp tax return, or the LLC, which may just be a state form. So I don't want that to get lost, even though the tax is very similar. The preparation of those business returns could be a couple grand. I mean, of course, it varies widely between who you use and where you are, but that can add a significant amount in relation to the tax. So that's the tax by entity type, with a real example of just earning total money in a little over $250,000 and netting 150,000. So now that we've gone through the taxes that apply to the various entities, I wanted to do a more qualitative discussion on why you might want to incorporate or become an LLC and why you might not want to. So I feel that the best reason to become an LLC or an S Corp is if you work with a customer who requires you to be a corporation, particularly when you're doing business with public companies or larger entities. Many of them have a requirement that they only do business with other entities, that they won't do business with sole proprietors. And I think that stems from the independent contractor versus employee debate. And if they're doing business with another corporation or LLC, that kind of avoids the IRS looking into that. Whereas if it's a sole proprietor, then they would have to worry about how many other clients the sole proprietor has and what percentage of total income, all those qualifications for an independent contractor. That's my intuition. I don't know why some companies require vendors to be an LLC or corp, but that's a good reason, because a customer you have or a customer that you want, a prospective customer that you know they only do business with corps or LLCs, that's a great reason to become one. You may want to be a corporation for legal protection of your personal assets. And this topic comes up a lot, particularly with attorneys speaking about being an LLC, so that if you were to have an issue where someone's suing you in your business, that they can't then go after your personal assets. And while that is true, if you have a separate entity, that it limits your liability, which is the whole reason that the entity type is called LLC, that's true. However, you have to be very careful to follow the rules. And I will say, practically speaking, almost every LLC in the world in which I work, the micro businesses that are grossing, 2.5 million and less, almost all of them will violate the LLC requirements in some way. And that fact makes it so that the litigant can go after their personal assets effectively. There's a phrase called piercing the corporate veil, and that's because the LLC owner maybe did a transfer from the business account into their personal account, maybe to make tax payments rather than doing it through wages. That would be the case for an S Corp. For an LLC, they have that ability as a as a sole owner, but they may also forget to file a statement of information that they have to do every couple of years. They may forget to write corporate minutes once a year, or some other legal requirement of being a corporation, have a board meeting. So those facts, if you're just incorporating to protect your personal assets, and then you essentially behave like a sole proprietor, then if litigation occurs, they're going to be able to get to your personal assets in most cases if you violated the corporate requirements. So that's why this is great to incorporate to protect your personal assets, but you just have to be very careful to follow the rules. And the other thing I think is worth considering on becoming an LLC is, can you buy insurance for the type of risk that you see happening? And is that insurance less expensive than the franchise tax to be an LLC? If you can operate as a sole proprietor and buy lots of insurance at a relatively low price, then you can not really worry about your personal assets being at risk, because you've got so much coverage through the insurance. Because the insurance is really quite reasonably priced for professional liability insurance anyway. So you may want to be incorporated simply because you feel better about being a corporate business or an LLC. You don't have any business reason to become incorporated. I mention this because I think this is a great reason to become a corp or an LLC, just because you want to and admit it. So it's one thing if somebody says, oh, I became a corporation because I think it's going to save tax, or I was advised, or whatever. Just become a corporation because you want to. That's your prerogative as a business owner, and I think that's perfectly fine. And then finally, you may want to incorporate if, I feel like I'm doing a Jeff Foxworthy bit. It's not as funny. It's not funny at all, in fact, but it's that repeated line of, you may want to incorporate if your state has low or no franchise tax. The examples I showed before, where to be an LLC in California, especially with gross receipts over $250,000, you're going to pay $1,700 to the state for the privilege of being an LLC. In other states, there may be little or no franchise tax. It may be really nominal, a $25 annual fee, something like that. And if that's the case, then you get all of the benefit and don't have to deal with any of the tax delta, or the tax delta is very small. So on the flip side, there are some reasons why you may not want to incorporate. And the primary one is that there are those additional tax returns required. So particularly if you self-prepare your individual tax return, if you become an LLC, S Corp, or C Corp, you are most likely going to hire a preparer to prepare that tax return. So there's a separate tax return. If you're an S Corp, you're paying yourself through wages, so there are going to be payroll tax returns. Most small business owners who are S Corp are going to use a payroll service for payroll. I'm sorry about the lighting. I am in sunny California. It's pretty early in the morning here, and there's a window just to my left, so I have almost no control over how much light is beaming in here. So there's a separate tax return. There are separate payroll tax returns. You may have a payroll service involved. So it can become more expensive and more administratively, maybe more of an administrative hassle to deal with those additional tax returns and processing payroll in and of itself. And then you may not want to be a corporation because you have those additional legal filings In California, there's a statement of information filing. It's a pretty simple thing, but it is a thing that you have to do every couple of years. If your address changes or if ownership changes, you have to file with the Secretary of State, and then of course the additional tax return. And then the final reason you may not want to incorporate is because if you are an S corporation or a C corporation, you are prohibited from commingling funds, meaning making a transfer from the business account to your personal account. You need to do that through wages, or if you've evidenced retained earnings, then in the subsequent year, you could have a line item in your minutes that says that you're going to transfer some of that retained earnings in the S Corp example. There's quite a bit of formality around that. It's not as simple as sole proprietor being able to transfer money willy-nilly, or a sole proprietor doesn't even really need to have a separate business account. If you can separate business and personal transactions, you could technically, not recommended, but you could technically operate out of a personal bank account. So I wanted to dispel a few myths about corporations and LLCs in terms of benefits, because I feel like, and I know that the things that I'm saying today are counter to a lot of the things that you'll hear, particularly from attorneys and other accountants, but I promise you, there's no cover up on this. I'm telling you, this is exactly how it is. And the information that I presented today is irrefutable. This is exactly how it would play out on tax returns. So if someone else is telling you that you should incorporate and that your business is going to be better off for it, you can reference this and go into specifics to find out, to reconcile what the delta is in that person's thinking. So one big myth about corporations or LLCs is that there are additional deductions or benefits for, like, small business owners love to use the term write-offs. So small business owners sometimes feel that there are just a lot of write-offs that can be done with corporations or with LLCs. It reminds me, I'm older, so I remember the Seinfeld episode where Kramer talks about the insurance company just handling something as a write-off, and Jerry asks him, "Do you even know what a write-off is?" And he's like, "No, Jerry, but I'm not the one doing the writing off." So anyway, there is in fact very little, almost no difference in terms of deductions. Business expenses are based on ordinary and common expenses, ordinary and necessary expenses of a business. And that extends also to automobile use. Sometimes business owners feel like if the corporation buys the vehicle, then there's more in terms of deduction. But that is not true. What is true about the expense of automobiles is it's based on business mileage as a percentage of total mileage. So it doesn't matter who owns the vehicle or to whom the vehicle is registered. You're entitled to the deduction if you use the vehicle in your business. And there's one other, thank you, Sarah. There's one other item that if you are a corporation or an LLC, there is now a new business ownership information, I think is the I, filing requirement. So you now need to report through, I think it's FinCEN, that there's a federal entity that's requiring a filing that's due actually in January 2025, I think. So that BOI filing requirement applies to the corporate or LLC entities. It does not apply to sole proprietors. So it's just another efficiency of being I mean, you have to perform the filing. There's no money involved, but that filing is a requirement. So, um, so your ordinary and necessary expenses will be your expenses regardless of what entity you are. There's one difference with a C corp. There are some medical expenses that can be a deduction because I want to make sure there aren't any holes in the information that I'm sharing. But by and large, with that one exception, really deductions are the same. Whether if you buy something that's related to the business, ordinary and necessary expense, it's going to be a deduction regardless of what entity type you are. And then the second big myth is that if I'm a corporation or an LLC, without doing anything else, I've protected my personal assets. And as we discussed on the prior slide, it's conditional on you having met the requirements of a corporate owner, doing the board minutes each year and filing the statement of information, making sure that you are a corporation in good standing. And then finally, I almost made a separate slide and said, and one more thing. The third myth is if I'm an S corporation and I don't pay myself wages, then I avoid paying Social Security, Medicare, and payroll taxes. And while it is within the discretion of the owner how much wages that owner pays themselves, let's say in an extreme example, we've got that $150,000 net income, and the owner decides to pay no wages. It is true that the corporate K-1 that's reporting the income to the owner will show $150,000. There will be no wage income, and the K-1 will show $150,000 of income that is not subjected to Medicare, to Social Security and Medicare, the self-employment taxes. So the thought by the business owner is, I have avoided Social Security and Medicare tax, which is significant. That's 15.3% up to the first about 160,000. So at first blush, that is a tax saving idea. But what it is in reality is evading taxes, because you are specifically precluded from becoming a corporation solely so that you can change your tax picture, basically. Let alone that business owner who pays no wages and has no earned income from the S corporation won't have any basis for making retirement contributions. Those are based on wages. And should that business owner go for a loan, say a home loan, the lender is going to see that the business owner has no earned income. Earned income is what they're after in terms of qualifying for home loans. And earned income, the most common thing, it comes through wages, whereas dividends and interest, capital gains, those are not considered earned income. They're not subjected to Social Security and Medicare. And that's the same with K-1 earnings from a corporation. So if you are an S corporation, you are required to pay reasonable wages to the owner. So if the IRS were to see that scenario where $150,000 is going straight on the K-1, there are no wages paid to the owner, they would be asking the question, is it reasonable that if you needed to pay somebody else to do everything you do in the business, that you would need to pay that somebody zero in this case? And the answer, of course, is no. And in most cases, you want to pay out almost all of the earnings as wages anyway, so that you can make higher retirement contributions and so that you can get withholding on the wages so that there is not a April tax surprise. So those are my myth busting elements. and another reference to your local SBDC. But of course, if you're in the area of the North Central Texas, SBDC is available to you, and that's why I'm here today. So I'm always glad to answer any questions that have come up. I saw some in the chat, and I'm not sure if I got to all of them.
I had a question, Bryce.
Yeah.
If you, let's say you don't become an LLC and you continue to operate as a sole proprietor, and it comes time to sell your business, how does that work if you don't have an entity and you've not declared yourself as a firm and it's all about you?
Yeah, great question. So because the thought is, if I'm not a corporation or if I'm not an LLC, what do I really have to sell if I'm a sole proprietor? And the reality is that most business sales are asset sales. There's two types of sales. You can sell assets or you can sell stock. Most business purchases in the small business arena are asset purchases. So they're going to be purchasing the hard assets, fixed assets of the business that are on the depreciation schedule, or they may be buying, like in the example of architects, engineers, accountants, attorneys, the purchase price is generally, I hate to burst everyone's bubble here, but the purchase price is generally some multiple of gross earnings for a year. So whatever you bring in a year, that's going to be the basis more or less for what the purchase price is going to be. So the agreement would basically be that the business owner who's unincorporated is going to stop serving those customers in exchange for the purchase price. So there's no downside or no difference really in terms of one's ability to sell their business, even if they're not incorporated. Does that make sense?
Yeah, that makes sense. Now, the other question also is about DBAs. If they want to have separate revenue streams and they want to, do other services, and if I'm just talking about services firms here,
Yeah.
more or less, and if they want to do that, then does the LLC lend itself a little bit better to do all that?
It can, but you could also just have multiple businesses that are unincorporated.
Sure.
So I don't see that as something that really determines whether they become an LLC. I will say though that in the mind of the business owner, it can seem more logical to be an LLC, especially with multiple lines of business. So I'm, not against it by any means. And like I when I gave the example of one reason to become an LLC or corporation is because it feels right to the business owner. So that's as good as a reason as any to be an LLC. Sarah,
Thank you.
yes.
Any other questions?
Oh, yeah,
Yeah,
Sarah has her hand up.
I have one. Thank you so much, Bryce.
Mhm.
And good morning, and thank you for such an informative talk. This was really great. Yeah, I used Collective recently, which like sets up businesses and has this lure of saving money on taxes, et cetera, et cetera. And it's like, okay, we'll set you up as an S corp. That's their lure. But I noticed that they set me up as a single member LLC with the 2553 election, which means I have to run payroll, all this stuff that I didn't really want to have to do. So I'm wondering, as the single member LLC and with the form 2553 filed, when I'm opening accounts and things, do I need to say that I'm an LLC or do I say that I'm an S corp? The bank got confused and I wasn't sure.
If you're an LLC, then you would say that you're an LLC, even though for tax filing purposes, you may be an S corp. The entity itself is really the LLC.
Thank you. Tricky, tricky.
Any other questions? If not, I'm going to share my screen. Thank you, Bryce. This has been really educational. For all of you, thank you for joining us. And we will be sending out a survey at the end of this webinar. And here are the upcoming webinars, as you can see on your screen. We have one coming up on the 15th on QBO, some others with HR. You could go to our SBDC website and register for these webinars. You can get contact information there. You can also schedule an appointment with an advisor. You'll find resources for small business owners, and that's what you could do at nctc.sbdc.edu. At this moment, I'd like to take this opportunity to thank our funding organizations, the Small Business Administration, the State of Texas, the North Texas SBDC Regional Office, and the North Central Texas College. Again, thank you all for joining us today, and we look forward to seeing you next time. This concludes our webinar.